you, Marie-Alix. Hello, everybody. So I'm Lenny Kessler. I'm heading the ESG committee for CFA Society France. As a volunteer, I'm a consultant on ESG side of that. So at the committee, we have a series on climate that we started last month with an event on transition with Natixis and Jean-Marc Jancovici, which most of you probably know. And Monica had the great idea of making a second one on the adaptation side, focused on real estate. So this is what we're going to have now. So Monica Aribranu is part of the ESG committee, and she's also a consultant on ESG, more focused on the banking side. And this was an opportunity to work with the Financial Institutions Committee, which is headed by Antoine Flippot, who's going to co-present tonight. So Antoine also looks at ESG. Obviously, we are focused on this. He's working at Generali, and as an asset owner, all these questions are quite important for them. As most of you may have seen, the IPCC report came out last month. It's quite dramatic. I think the subject is really up to date, both for obviously the world and humanity in general, but for investors, as we're going to see tonight. So without further ado, I don't want to take up too much time. Thank you very much, Beatrice Gage, Fabrice Lombardo, Nick Payat, Kat Thorogood for being here. Monica and Antoine will present you in a minute, so I'll give the floor to Monica. Thank you.
Thank you, Lenny. I think Antoine goes first. Antoine, you are muted.
Hi, thank you, Monica. Thank you, Lenny. Good evening to all. So we are very pleased to welcome Beatrice Gage. So Beatrice is Head of Research and Innovation at Swiss Life Asset Managers France. Good evening, Beatrice. Could you just tell us a few words about your role and involvement in real assets and climate change, please?
Well, indeed, I'm doing asset allocation. Basically, I'm a quant research person, so I do research from a portfolio perspective. And of course, anyone who does asset allocation today can't do real asset allocation without taking into account ESG. And I'm doing asset allocation over the whole range of asset classes from, let's say, equities to real asset, including infrastructure and real estate.
Thank you so much, Beatrice, for joining us. So our next panelist is Fabrice Lombardo. Fabrice is heading the real estate business at Swiss Life Asset Managers Funds. Good evening, Fabrice. Same question to you. Would you be able to introduce yourself and tell us about a little bit about your work on sustainability?
Hello, I'm Fabrice Lombardo. So I've been working with Swiss Life Asset Managers since 2008, and since then we have been fully committed to the ESG topics by creating analysis grid already, I would say 10 years, more than 10 years ago. And we saw in the past 10 years the investors becoming more and more demanding regarding especially climate risk. And so it's something which is at the heart of our conviction since then, and since more than almost 15 years.
Thank you, Fabrice, and welcome to the panel.
Thank you.
Thank you. No, we are also pleased to welcome Kat Thorogood. So she is ESG analyst at Legal and General Investment Management, specialized in real assets. So it would be interesting also to have her insights from an ESG standpoint. So hi, Kat, could you please also, same question to you, tell us a bit more about your role and involvement in the topic?
Hi, Antoine, and thanks very much for inviting me to join you here today. I'm Kat Thorogood. I'm an ESG analyst in the real assets division of Legal and General Investment Management. And my role involves ESG integration across our portfolio, involving a whole suite of topics, but I have been leading on our approach to physical climate risk assessment across our real assets portfolio. And that's involved working very closely with another one of the panelists, Nick. And before joining LGIM, I worked in a consultancy specializing in climate risk and supporting other financial institutions with understanding and adapting to their climate change related risks.
Thank you, Kat, and welcome to the panel. And our last panelist is Nick Pyatt, who's Director of Physical Risk Assessment and Adaptation at XDI, a provider of physical risk analytic solutions. So welcome, Nick.
Thank you very much, Monica. So yes, I'm Nick Pyatt at XDI. I work in the climate adaptation field, assessing physical risk and supporting organizations to consider what's their optimal decisions are in the face of those risks.
So welcome to everyone. Thanks a lot for accepting the invitation and for sharing your insights and perspective with our audience. So the CFA France and any other CFA members that decided to be with us today. As Lenny mentioned, climate change is becoming an emergency. The last IPCC report, as Lenny said, it's very worrying. It was called the Code Red for Humanity. And in addition to that, there is a lot of scrutiny over asset managers, from regulators, from investors, from various stakeholders to, let's say, to take into account climate risk broadly. So I thought, Nick, I will turn it to you for an introduction of physical climate risk and why investors should worry about.
Good evening, everybody. One of the things we now know beyond doubt is that the climate is changing, and it's changing because of human activity. The climate is changing in ways which are way outside now, beyond what can be explained without human activity. And that has significant implications for those of us on this call. The physical impacts on property and asset management are going to change. In our sector, we make decisions which lock us in to the climate impacts for a very long time. And over the life of those decisions, those climate impacts are going to change. And so to make good decisions today that manage those long-term risks, we need to understand what those physical risks are. And those physical risks can be property damage. They can lead on to increased insurance premiums, decrease in collateral value. They can cause business interruption to your own organization or your counterparties and customers. So what do we need to understand in order to reduce the impact of those physical risks? Because physical risks are only potential risks. The actual vulnerability to those risks depend upon how well we manage them. So we need to understand, for a start, we need to understand our resilience to the current climate. Are we resilient to the current climate? Because it has already changed and we may not be. And then we need to understand how those physical risks will change over time. Because it could well be that there are physical risks which are not present today, which will appear over the life of our investment. And also we need to understand the probability of those hazards. So if we are at right on the coast, we may be vulnerable to sea level rise. If we're on the top of a mountain, we probably won't be. But we may be more vulnerable to wind damage. And also, when are those things going to happen? So when we do some of our analysis, we find that there may be some risks which are non-existent until 2060, 2070, 2080. And so to understand what those distributions are can be important, because even if they don't exist within the life of our investment, they may affect the value when we try to sell on, because people will start to think about the resilience of those risks later. Thanks very much, Monica.
Thank you very much, Nick.
Thank you, Nick. So we'll move on now to the investment management initiatives. Also, more especially, why is it important here for real assets investors in particular? So we'll give the floor to Beatrice. So Beatrice, you work in research and innovation. So could you please Let us know about like some potential financial damage linked to climate change, and also some estimates you have been working on lately.
Okay, thank you very much. Good evening, everybody. Happy to discuss with all of you from a research perspective and how research tackle these issues of physical risk and financial damages. Maybe that in line with what Nick said, I would like to make a couple of preliminary remarks from an asset allocation prospect. The magnitude of physical risk is highly related to the temperature trajectory, depending itself on the transition risk, and the higher the mitigation related to transition, the lower the physical risk. So basically the output of the allocation process can be highly different depending on the scenario of the temperature trajectory you choose. So physical risk related to climate change are well identified, as explained by Nick, and the financial implication of those physical risks have come to focus into real assets, real estate, given that pension funds have an average of 15% of their total allocation in real assets and 4% for infrastructure. So both real estate and infrastructure are real assets, and as such, they are considered as long-term duration asset classes. And both are definitely attractive to secure cash flow in terms of long-term liabilities. So physical risks are crucial for real assets investor given the long-term horizon of their investment. Swiss Life is 165 years old, for instance, so we have been holding assets within our portfolio for more than 100 years in some location. So the expected duration of physical damages caused by climate warming is 80 years according to IPCC. Nevertheless, the impact can already be observed in present values depending on the discount rate attached to the future cash flows. Actually, it's fair to say that there is a controversy on the magnitude of the discount rate level attached to cash flows. In a traditional DCF analysis for investment, for instance, the discount rate is usually between 6 to 8%, while economists consider that the discount rate should be in the range between 2% and 4%. So we consider the financial differences and the financial damages, and ecologists would assume a zero discount rate or even a negative discount rate. So it would take too much time to dig deeper, but that makes sense to mention it, at least for a CFA audience. Coming to physical risk and physical asset, real estate is especially vulnerable to water stress, hurricanes and flooding when referring to the world property market cap this time. And these three physical events exist for the largest property market worldwide, including the US, the UK, the Netherlands, Australia, South Africa, and to a lesser extent to France. So these three climate events could cause both chronic and acute effects on the life cycle of our investment, as mentioned by Nick. Firstly, chronic physical hazard are related to water stress. They usually cause steady long-term effects. So that's important when you have a 80 years duration. And secondly, acute physical hazard are related to hurricanes and flooding, and there are several short-term effects. So both chronic and acute effects could vary depending on geographical locations and could increase the cost faced by investor, from increased operational cost to the potential for higher insurance costs, property devaluation, and in some bearish scenario, of course, the complete loss of the property itself. So these three physical risks or three physical events are highly important when you do a financial asset allocation exercise from scratch, for instance. Yes, I can comment the slide here. The slide is quite interesting because it showed the estimated multiplication factor at which the frequency of sea level exceeding a given height will be increased under the SCP 4-point scenario, which stands for representative concentration pathway of 4.5, not the worst case scenario as designed by the IPCC, it's the middle case. As we can see, many coastal areas in the lower altitudes, East Asia and the US East Coast could experience a multiplication factor, as written here, greater than 100. And this indicates that what was currently a once in 100-year flooding event would happen annually or more frequently due to sea level changes. So this is for the top-down approach related to flooding and financial damages. But maybe we can move to the next slide for the bottom-up approach. Sorry. Thank you. With a bottom-up approach to appraise the financial risk of flooding risk exposure in a country, I've decided to focus my attention on the UK property market for different reasons. First reason, the UK is the largest property market in Europe in terms of volumes, value, as well as square meter. Most international investors, such as pension funds, sovereign wealth funds, and other institutionals, are exposed to the UK market, and flooding risks are scrutinized with sophisticated tools in every acquisition process and also from a risk management perspective. Second reason why I've chosen the UK market, flooding is the most prevalent climate hazard in the UK, and models predict that flood occurrences will continue to rise over time. It's predicted by the UK Climate Authority that UK households at risk of flooding will be more than double by 2050, putting almost 2 million properties at risk. So this is not a small number in terms of assets, but also in terms of market value. So here I've taken a work done by MSCI, so the leading provider of benchmarks in also the property industry. MSCI found that within their sample of properties, that basically 4% of the properties in England were in medium to high risk flood zones. However, as shown by the map, exposure varied widely by specific location and also sector, even though the map doesn't make such a kind of a discrimination between residential and commercial properties, for instance. For example, in England, second most populous county, the West Midlands identified here by the red cycle, thought only 3% of measured assets by capital value were ranked as medium to high risk, as you can see. 30% of residential assets in the Midlands were deemed at risk. So that's not a small number. So institutional investors might not be overexposed to the Midlands, but households may own their home and are highly exposed to flooding. So here, the risk might be shifted to insurance company. Focusing on the city of Reading, as you can see here, 54% of the capital value of assets across all sectors is at risk, not a small number, on a sample of around 900 million US dollar value of assets. So this is for the financial damages in terms of appraisal.
Thank you so much, Beatrice, for sharing interesting analysis indeed. I think XDI also published something similar for the UK market as well, coincidence. So that's something Nick can comment on later on. Fabrice, we thought that next we'll turn to you to get some perspectives what physical risk implies from an investment strategy, investment process perspective.
Yes, thank you, Monica. It's a very good question. The climate risk now is fully at the heart of our investment process, being both or at the acquisition, so when we buy an asset, and also when we manage an asset. And the way we analyze this, I would say, physical risk and this climate risk is first that we look at the physical risk. Bearing in mind that we are mostly invested in Europe. So what does it mean, the physical risk for our real estate assets is that we are mainly exposed to the flooding risk, to, for some of our assets, to the sea submersion risk when we are located on the coast. And the third one, which is dryness. Dryness means that we have clay in the subsoil under our buildings, and if this clay moves, it might really damage the foundation of a building. So it's quite a huge and costly risk. So that's, I would say, the existing risk. And we have also what we call the, I would say, forward-looking risk, which are the obsolescence risk. And here it is more linked to the global warming risk. It means that sometimes in the city center in the future, with having very, I would say, warm period in summer, it will impact the ability to stay into our buildings. So it will imply costs, being discussed, maybe more powerful air cooling systems, but also meaning more electricity consumption and maybe at some times a carbon tax. So this is this second type of, I would say, forward-looking risk that we analyze in our process. And we have a tool, and when we have this tool and we really look at this macro risk, as discussed, and we have maps and tools as presented also by Beatrice. And we have also, I would say, reports specific on each asset. And during this report, it will allow us to see what should be the CapEx, the capital expenditure, the refurbishment work to be done on these specific assets. And it's clearly the way we use to quote this risk. So it means that and that's really, we are doing it for all of our assets during our due diligence, and then after, periodically reviewing what's going on our portfolio. And that's the way we quote this risk, is really trying to have an analysis of what's going to happen and what could be the mitigation measures, mitigation, and meaning refurbishment and CapEx at some point. So that's the way we use to assess the physical risk and the implication of in our investment strategy.
Thank you so much,
Fabrice.
Yeah, sorry, I was not sure whether you were ready to speak or not. Vas-y, Antoine.
Thank you, Fabrice. So we focused a lot on the real estate as the main asset classes for real assets, also for investors. So we move on to Kat. So we'd like to hear about your experience, about some practical applications, some tools maybe you've worked on at Legal and General to tackle physical risk, and also to help us to better understand the main focuses you put on it, and how do you see that from your ESG analysis standpoint.
Yeah, thanks, Antoine. I'll just firstly provide a very quick bit of background on LGIM real assets, and then I'll talk about how we're analysing climate risk across the portfolio. But our real assets is a business unit within LGIM, an investor, owner, operator, who manages assets across real estate equity, and also a private credit business, which is long-term debt financing across corporate, alternative debt, infrastructure, and real estate debt investments. And we recognise the increasing risk that physical climate change is expected to pose to our portfolio, and have been working predominantly with XDI, so with Nick's team, to increase resilience to this challenge, particularly by fully embedding consideration of physical climate risk into our decision-making processes. This process has initially started with our real estate portfolio, but is increasingly looking at following a similar approach across our infrastructure assets. And as Beatrice said earlier, flood risk poses the biggest challenge to our UK-based real estate portfolio. So this is also where we've started our analysis. I think there are three key areas where we've been looking to develop our approach, and that's gaining asset level insights so that we can build resilience to physical climate risk from the bottom up. Secondly, as Fabrice mentioned, it was developing our approach to due diligence to better incorporate forward-looking information at that point of the investment cycle, and finally responding to our TCFD, our Task Force for Climate-Related Financial Disclosure requirements. And on the first point, as I said, we very much approach this from a bottom-up perspective. And to do that, we've conducted an initial risk screen at the building level across our entire portfolio. So that means analysing the individual building components of our larger multi-building assets, as well as our single building assets as well. And this has allowed us to identify medium and high risk assets. And we're now working through a very involved process with our asset managers and XDI to capture more asset-specific information that might have a material impact on the overall risk profile of that asset, be that age, building materials, or crucially, any existing adaptation measures that have already been incorporated. We then rerun the analysis, and that gives us a much better representation of the actual risk at that asset. And once we have this information, if the asset is still appearing to be risky, then we can then move on to developing tailored adaptation strategies. Again, working with XDI, but also our on-the-ground consultants as well, to help us review the effectiveness of different mitigation measures, and to get a real understanding of how we can actually make these assets more resilient. And just to quickly run through the other two elements that I mentioned, But with due diligence, I mean, flood risk has always been a consideration in our due diligence process, but we've recently been working to incorporate that that forward look more in a more embedded way, more integrated way. Again, to make sure that it's constantly a consideration at all key decision points. And here we developed a new process where an initial high level climate risk review is conducted, which looks for any red flags across the site. And if any red flags are identified, this triggers a number of other levels of analysis which may be required to make sure that we have a full understanding of potential future risk at that site. And finally, on TCFD reporting, clearly it's a key driver behind the development of our approach. And we do include information on our approach to physical climate risk in our disclosures. But because we've initially focused on really understanding asset level risk, we're now in the process of determining the best methodology and metrics to best communicate this risk at a portfolio level.
Thank you so much, Catherine. It's indeed very interesting to hear the steps that the analysis involves and how you can enhance it, and also what it triggers. I think the follow-up for the red flags, as you mentioned, it's an important piece of the story here. So now we talk about physical risk, analytics, etc. Everyone heard about scenario analysis and how complex it is, but we don't necessarily all have a good understanding of the steps involved, what it entails. And so I thought, Nick, you can maybe share with us how it works, using, of course, the example of what XDI does.
Exactly, I'd be very happy to. Thank you, Monica. So XDI, we're a group of people who started off doing things which are nothing to do with climate adaptation, and now we do nothing but. We're engineers, we're ex-firemen. Used to be a forester, but actually it all applies into the way the logic which we apply to our physical risk analysis. In my case, I had to think as a discipline. I'm planting millions of trees, 30 centimeters tall, but you have to, unless you get it right, when they're 20 meters tall, the climate impacts will decimate the investment. And so we bring those sorts of disciplines. And as our engineers here thought, how does this actually work? How does climate impact actually happen on an asset? And so we brought those things to this work. And so the foundation that allows us to make these analyses starts off with thinking about, okay, well, how does the climate work? Getting models of the climate, temperature models, precipitation, wind, how the soils work, how the seas behave, and then applying a range of different climate scenarios, because as been mentioned, we have a whole range of possible climate futures. So we need to be able to be ready for low case scenarios, high case scenarios, something in the middle, because even if when the science is nailed down, we don't know what carbon emissions are going to be. And then we apply a massive amount of computing power to create probabilistic assessments against a range of climate change scenarios. And we apply a range of scientific methodologies to those things, in using that probabilistic approach, using general circulation models and regional climate models, a whole range of things that allow us then to test the physical impact of 10 physical hazards. We've got a global coverage. So if you give us a latitude or a longitude of anywhere in the world, we can tell you what the physical risks are. And we've created over 120 different asset types so that we can understand how those physical risks would impact on a particular type of asset. And we have a very fine range of granularity, the finest granularity that the climate models will allow us to have. And for decision makers, for investors, for asset managers, We then produce a series of results, which are about climate-adjusted hazards, how they change, how those hazards change with time, the value at risk that those changes affect. So we can identify then what the high-risk properties in a portfolio, for instance, might be, so that we can pay particular attention to those and prioritize those, what the failure probability of those priorities areas are, and how the damage distribution. So which bit of the property might be damaged under different scenarios, at what times over future years, under which scenarios. Next slide, please, Monica. And when we thought doing that was a good idea, what we also thought was an asset, a building, is not a homogeneous blob. What is it? It's roof, it's foundations, it's windows, it's electronics, it's guttering. Those can be very different in different buildings. And also they respond differently to the same hazard. So if there is a flood, the roof we don't need to worry about the roof, but you need to maybe think about the foundations, the ground floor electrics, if you've got a basement. If there's a high wind, then you may need to start thinking about the roof. But you might not only need to think about the roof if there's damage to the roof, but it stays essentially intact. Okay, there's some value at risk there. But if the roof blows off, then there's also going to be damage to the walls and other parts of the asset. So different intensities and natures of climate risk have different patterns of risk within the physical construction of each asset. And so we've broken all of our assets into different sub-asset elements. So we can really, in a fine-grained way, understand physical impacts of different climate hazards at different intensities over time. Could I have the next slide, please, Monica? So what can we do with that? Well, we can look at a large spatial area and look at heat maps of where there is likely to be risk. And then we can break down the patterns of risk. So I don't know whether you can see on this slide, the image second from the left, we have different curves here for the patterns of development of different types of hazards. So in this particular case, there is a slow growing curve between now and 2100, which is increasing heat impact. Later, towards the end of the century, all of a sudden there's a sharp uptick there, and that's coastal inundation. Sea level rise all of a sudden kicks in as a risk and starts to overtake it as a value at risk hazard for heat. And there are other impacts, but they're far lower impact and not things we particularly need to worry about. And then if we look at the image, the next image along, third from the left, we then break down the value at risk and the value impact at different levels of intensity on individual assets. And so if you're able to see that slide, you would see we were looking at the physical infrastructure, the electronics, mechanics within this particular asset. And each of those has a different value at risk under the same climate impact. And so we can break it down to those levels. And from that, we can give a very sub-asset level assessment of value at risk, what we call technical insurance premium, which is the annual value at risk at each year. The high identifiers, as we said, the high risk properties, the climate hazard data, failure probability of each part of the asset, and then damage distribution. The next slide, please. What we can then do, if there are an investor has multiple assets, then we can locate those assets on a map, and they can start to see where to prioritize or not. In this particular case, this is BP's petrol stations around the UK, and this is part of their asset portfolio around London. There are some yellow dots. We don't need to worry about those. Those are low risk. There's some orange dots in there, which are medium risk, and there are some red dots, which are high risk. And we can break down and look at the individual risk profile of each of the individual assets. And in the particular output, we've got okay, we can move on to the next thing. So then we've got, we can pool our assets into a portfolio and show the pattern of portfolio risk over time. And so in this case, we've got the current time, 2050, 2100. And as time goes by, then the risk profile changes. Now, and we have a traffic light system in terms of risk, which is guided by the US insurance sector, which views a risk higher of 1% probability risk per year as being high risk and at risk of becoming uninsurable. A medium risk between 0.5% to 1% probability of a risk, which is a moderate risk, and then below that, low risk. But if you can see here over time, those the portfolio, much more of the portfolio comes into risk above 1%, and significantly more than that moves from low risk into moderate risk. Thank you very much, Monica.
Thank you, Nick. So I mean, in terms of main key takeaways, we can retain from this first part. Like we've seen great initiatives in terms of tools, models, sophisticated analytics as presented by Nick. So right now we'd like to move on to the next section. Of course, when we talk about physical risk, we cannot avoid also the increased, let's say, regulatory scrutiny on that with the inflation of all the different reportings, depending also if we are within the insurance world or banking world. But also like some increased need to discuss directly also with the clients, because they have some they need to have some information about that and to understand, I mean, those new concepts. So right now we direct my question to Kat. So Kat, can you tell us how do asset managers proceed? I mean, to provide more detailed information, more granular information to investors with what is now required from a regulatory standpoint, and what are the challenges and still some points of attention you would like to highlight?
Yeah, thanks, Antoine. As you say, going forward, I think there is only going to be an ever-increasing amount of scrutiny on us as to how we are identifying and responding to physical climate risk across our portfolio. And we're already seeing a significant increase in the amount of information that our investors are asking for. And that's to do with everything to do with ESG. The number of questions are increasing, but particularly around TCFD related metrics. It's something that we've noticed has really ramped up recently. Because our investors also need to be responding to TCFD, so they understandably want to have a really good understanding of the potential risks to their investments, particularly so now that disclosure is already mandatory for a number of institutions in the UK and will become mandatory for many more over the next few years. But I think sometimes what we find is there is a bit of a lack of correlation as to what is being asked for and what we are currently producing. And I think that's because there's a range of third-party providers which different organizations can use, and they all provide slightly different metrics, or even if they are the same metrics, such as a climate value at risk, then it's sometimes difficult to see how comparable those metrics are across these different providers. They're all aligning around TCFD, and clearly the purpose of TCFD is to improve transparency and comparability. It's definitely a step in the right direction, but I don't think we're quite there yet. And as I said earlier, a key driver for us in our approach to physical climate risk is really understanding and improving asset level resilience. And lots of the portfolio level metrics that we're being asked to produce by investors don't necessarily help us to achieve that asset level understanding, which means I think in the short term we're probably going to need to provide both. So incorporate a top-down assessment that meets our investors' needs, as well as doing our own approach that meets our own needs to build resilience. But I think with anything, the best way to overcome these challenges is going to be through ever more increasing engagement with key stakeholders, which is why it's great to have sessions like these. But ultimately, that will help us to understand how investors need to use that information, so that we can make sure that what we're providing for them meets those needs and also helps us to best define our own approach to doing so.
Thank you, Kat. Very interesting perspective. Indeed, the disclosure requirements and also investor expectation are increasing, and that trend will keep going that way, right? Of course, just as with global warming, we can just sit there and observe, but we can also act. For physical risk, we can take adaptation measures. Beatrice, I thought maybe you can share with us an example of what adaptation can mean.
Thank you, Monica. If I may, I would like to say a couple of words on XDI and what Nick presented to us. Actually, I found it very interesting, sophisticated, and a powerful tool for the industry. And what I've noticed here is that the tool calculates proper value at risk, while the MSCI research output to England I was referring to doesn't calculate a value at risk, climate value at risk in the proper financial terms. So that's the big difference. And I think that it's important to spot it. So thank you very much for this introduction to your tool, Nick. So coming to the adaptation and the question, I've presented the risk related to some counties of England. I've talked about the potential damages, but not about adaptation. So Greater London, for instance, is less exposed given its adaptive measure, and this was due in large part to the Thames Barrier, the second largest movable flood defense system in the world. And the barrier protects Greater London from high tide and storm from the North Sea. So the Thames Barrier is definitely in line with the risk management of physical risk, protecting, of course, billions of pounds in property value, as well as more than 1 million residents. In terms of physical adaptation, the Netherlands is one of the role model nations with advanced planning and innovative approach to address physical risk, and adaptation. The Netherlands flood protection system is famous and efficient. It says to have only a 1 in 10,000 probability of failure, which is of course essential in a country with 2/3 of its economy in low-lying areas. So the adaptation has been key to secure existing investment from the largest pension funds in the world, so highly exposed to commercial and residential assets in the Netherlands. To the most, I would say, let's move to the most extreme adaptation, and this can be illustrated with an example, and more specifically, something that happened in Indonesia. Thank you very much, Monica. The adaptation, to physical risk here means the move of Jakarta to a new location, a new island. As you can see from a geographical perspective, Indonesia is an archipelago nation. It's quite clear. So the physical risk here in Jakarta is relating to flooding again. So the capital, which is home to about 10 million people and around 30 million in the greater metropolitan area, has been described as the world's most rapidly sinking city, and it's estimated that 1/3 of the city could be submerged by 2050. So just to give an idea, the city is sinking, in 15 centimeters per year, making it vulnerable to sea level rise, of course. So in order to avoid the physical risk, the government has decided to a radical adaptation, as mentioned already. Last January, the country passed a law to transfer the capital city, Jakarta, from Java to the east coast of Borneo, as shown by the chart. So this relocation to a new city, it was the former one, this is an appendix, but fair enough. This relocation to the new city built from scratch and called New Santara is expected to cost as much as $32 billion and will not be completed before 2045. And surprisingly, I think it was the previous map, but finally it's the first map of Indonesia, but no worries. And surprisingly, remaining assets, for example, within the island of Java, will lost most of their value. But there is no, what I can say, there is no magic point in terms of financing and negative also externalities related to such a drastic adaptation. The government would only finance, very good, thank you, 90% of the estimated cost of the adaptation, hoping private investment to cover the rest through public and private partnership. So far, Abu Dhabi and SoftBank were candidates, but it seems that they are not candidates anymore. So this is another example how we can deal with some physical risk by moving cities, but basically this has a huge financial cost as well as a human cost, because we are talking here about 30 million people. So far, financing is missing and no roadmap is available to see how the population will be relocated. And I've talked about also negative externalities, and of course the negative externalities will be related to the cost in deforestation. But this is the most extreme, let's say, adaptation to physical risk that could be given today.
Thank you, Beatrice.
Thank you, Beatrice. So it's yeah, it's very extreme, moving like from an island to another one. It's kind of incredible, let's say, that to do that. So also to answer your question, Beatrice, we'd like to get back to Nick, talking about the XDY tool. So I mean, this kind of example, Nick, is kind of extreme. But can you tell us also, to what extent your tool XDI could help with this kind of physical risk adaptation, which was illustrated by Beatrice, for instance, or going beyond?
Well, I think thank you very much. That's a really good question. And I think the principles I'd like to illustrate now are useful for helping that, and are actually based on some of the measures developed in the London flood protection approach that Beatrice mentioned, and has been picked up by Netherlands so brilliantly, and actually pioneered by my colleague Tim Reeder. So that's called an adaptation pathways approach. And one of the things that we need to think about when we are adapting to the climate is we need to think about uncertainty. There's a huge range of possible climate futures here, and there's a possibility of spending too much, either because we act too early or we act too late. So understanding the potential range of climate futures, what makes sense with what is certain enough now, but also making it easy to make future adaptations. And one of the things, and that's one of the things that we support investors to do. So in this particular slide, our top light blue line there shows the changing vulnerability, which is the annual, what we call in our term is technical insurance premium, or annual value at risk, going up in a constant line. But as you saw from our modeling, we can break down an asset into its constituent parts, and we can see here how different actions affect the vulnerability to different parts of the asset. So the black line shows an investment which is affecting protection to flood risk. All these are all about flood risk, but different parts of the building, the floors and some of the lower walls, are affected by maybe raising the floor. So we can invest in that, and we can see the impact it has on the annual risk. And then we introduce some raising of the electrics, which reduces the value at risk even more. And then we take some further measures in terms of taking our electronical equipment and moving that to other places. And then you can see we've managed to eradicate, for the period that we've shown, what the value at risk is. So we're not helpless in this, and we can break down the value of individual actions in this way. And could I have the next slide, please? And what we're then able to do is to show the return on investment of those sorts of actions. So in this case, we're looking at a particular step where we've taken risk out of a on the left, and we can see that the blue bar is the annual value at the risk in the years following that intervention if there was no intervention, and on the right we can see the annual value at risk as a result of that intervention. So we can see that that intervention pays for itself through the reduced value at risk. So those are the sorts of tools that can help decision makers in testing the value of their adaptation options. I hope that that helps to respond to your question.
Thank you so much, Nick. It's interesting indeed how we can follow that in the analytical tool. So that I think it's excellent news for asset managers. Maybe a prospective view as we are, nearing the end of the panel. Fabrice, maybe you can take this one. We thought, what's next? So what should asset managers expect, consider when it comes to climate risk in the future? Fabrice, you are muted.
Sorry. Yeah, no, I was saying that it's what we can expect is even more challenges, and I would say in various sectors. The first one, and Kat already mentioned it, is about reportings. So the need for report from institutional investors, but more and more from wholesale men on the street for their financial products will increase. And here the key for us as asset managers is going to have all the data and accurate data and in due time, because the reporting also delay are going also to decrease more and more. So that will imply a huge effort from the industry in the future. So that's, I would say, the first expectation, but we are already seeing it, and with the challenge is getting the data. The second one is what should we expect regarding regulation? Here again, pretty convinced that we will face more and more regulation for the institutional investors, but maybe per asset classes. We have already experienced more and more regulation regarding climate risk for commercial real estate. So it's easy, it's mainly imply, the corporate and the institutional investors segment. But in the future, if we begin to put, and we are beginning to see it, more and more regulation on the residential market, it will have a huge impact on the men on the street, on the voters. So that's, I would say, the second impact. And what we should expect also, and the final thing is maybe the elephant in the room. We discussed a lot of mitigation measures, how to relocate a own city, how to increase the height of a building. So everything of this has a cost. And who is going to bear this cost? And that's clearly what we are beginning to face, and we will have to discuss with our investors. So are we going to be able to increase the returns with such costs? It will only apply and happen for the real estate, but it will happen for all the sectors. It will only happen if we manage to get higher rent, which is not really sure. So will it impact the return of our assets? Or if we manage to pass this cost to our customers, being the tenant or a corporate, being its own customers, it will maybe lead to also maybe higher inflation. So that's the two question marks for the future. No answer yet.
Thank you so much, Fabrice. So we are actually almost at the end of the time for the panel. Maybe we can take a question or two, if there are any.
Yeah. Actually, so while you think and write your questions, I have a first one. Maybe for you, Fabrice, on GRESB, which we know is an important benchmark. Do you use it? How Now, how does it guide you? Is it the right tool?
Yes, we use GRACE-B as a way of rating some of our funds, but we also use other type of ratings. So for instance, we have other label, we have the SRI label, for instance, for some of our French funds. And as I mentioned before, what is really important is to have the data. Once you have the data for one asset, once you have the data and the action plan for each asset of your portfolio, then you're able to produce, I would say, any type of reportings. For us, as in the real estate industry, we are not relying on data from service providers. We need to get the consumption data from the tenants. And once we have it, we can use GRACE-B, we can use, yes, SRI label, and we can even, because we have some investors which are very, very in advance in terms of ESG policies, and we can also provide tailor-made reporting to specific investors. So that's, and GRACE-B is quite popular, we must admit, especially regarding, I would say, the Anglo-Saxon type of investors.
Thank you. So I have actually a follow-on question. Unless some participant wants to ask something.
We have a question on the chat actually from Fabien Ferron.
I didn't see it, sorry.
No problem. So I suggest we pick up that one and then we go back to yours, Lenny, if that's okay?
Go ahead, I don't see it. It's probably only written to you. Go ahead.
Maybe. So question here for one of the panelists. And we understand that the analytics are looked at right now from a bottom-up perspective, and there are debates on the way to represent it at the consolidated portfolio level, or regional or sectorial level. So can either Kat or Nick or who wants to jump in, of course, elaborate why this is so? So who'd like to start?
I can make a few comments on that. I think so. There are ways of consolidating asset level information at the portfolio level, but we have found that the metrics that we need to help us understand how resilient our assets actually are not the metrics that investors want to see reported at a portfolio level, and they want to see a climate value at risk, for example, reported at a portfolio level, which for us doesn't always help us get the information that we need to build the necessary adaptation strategies. So I think it gives you a really good overview of the general vulnerability of your portfolio, looking at those top-down metrics. But as I was saying earlier, I think at the moment we need both. We need the metrics to support our investors' reporting requirements, and we also need a separate set of metrics that help us understand how we're improving our resilience and how we are to help us demonstrate how our assets are being adapted.
Thank you, Kat. Thank you so much. Anyone else would like to react to this question? Back to you, Lenny, then.
Yes, a general question. I mean, we're talking a lot about the need for data at the asset level and underground work, both to analyze each asset and to have actually do the adaptation work. I'm wondering how much of that is weighing on your cost of running operations.
It has clearly a cost in terms of human resources, because we need, even if we can have some REA tools which allows us to get data, smart metering and all these type of tools are hopefully useful, but it requires, at some points we need some human to analyze and to set up all these action plans. So it clearly means more workforce.
All right.
Could I offer a thought?
Yes,
And,
please,
and having this is Nick Pyatt, and some of the clients that we work with, that there are costs, obviously. And those costs need to be worked on the basis of return on investment. But not everything has to be an extra cost. And as in so much in a way that an organization behaves, sometimes it's about the questions we ask our staff to take responsibility for, and within the same resources, ask them to slightly redefine the questions that they have. And so there can be cost neutral changes, but that tends to require a buy-in at the leadership that this is something we need to pay attention to. And some of those changes can have a significant impact on the ability to make climate resilient decisions. I just share that thought.
Thank you. We have a question from the audience.
If I may, I would agree with Nick, but because at the end of the day, when you have a kind of a medium to long-term view, it's probably less costly today because you're basically you are tacitly increasing the potential value of your asset. So again, it's a question of time frame, life cycle investment, and at the end of the day, it's costly today, but it might be not costly over time, and more specifically regarding the green premium you're having in the value of your building and the value of your portfolio as a whole. That's all, just a comment.
Yeah, I would think for the longer run as well, that the cost it's probably offset by the benefits of not being affected by climate hazards by large, but just sharing a thought as well. We have one more question on the chat. I don't know, Lenny, if we have time to take it or if you would like to move to the closing remarks and we tackled the last one.
No, we can take it. It's only one. We're running a few minutes late. I'm sorry for those who were on the schedule. It's a question from Fares Boukru. I hope I'm not mispronouncing too much. When working on the estimation of climate VAR for real estate, is there any benefits to integrate the diversification of asset locations at a portfolio level? How this could be added to asset level analysis? So I don't know. Who would like to take it?
That's a very good question, but I would assume that Nick can tackle the issue.
Yes, I think we see that happening with some of our clients, that they will divest out of areas that they find are at risk. And also in terms of asset level analysis, then it's now increasingly possible, and it's some of the things that Kat and other clients of ours want to know is the capability to look at a prospective new asset and to understand what those risks are and to factor that in. So we start to seeing it. Monica mentioned the analysis we have done in the UK property market. We've now conducted our assessment on every residential property in the UK, 40 million properties. So, and we have the ability now for, and we can do the same for commercial and other properties, of course. Somebody who is considering an investment can include this in their metrics very easily. And the same for land. We're looking at renewable assets, renewable energy assets and other infrastructure. But you have to be able to ask. You have to ask the question. The answer is available now, but you have to have it in your system to ask the question.
Thank you very much. So with that, I think I'll go I'll conclude. Asking the right question, I think is a perfect word to end this discussion. I also, I get out of it because I'm not in the real estate sector, so I've been learning a lot. I see there's huge challenges, mainly around data and regulation, like pretty much everywhere in the financial industry today. I understand that at the core, it's only understanding uncertainty, which is in a way reassuring, since this is pretty much what all financial people need to do, understand uncertainty. I guess it's uncertainty of a different nature, so we will have to get to understand and study, but it's probably something that we can grasp. With that, I'd like to thank you all, thank our attendants. I forgot to mention at the beginning that we actually, CFA UK is launching a new certificate in climate and investing for those who would be interested. This is an addition to the already existing certificate in ESG investing. And as just to end, also those who would be interested in a slightly different subject but still on the environment, Monica is also leading the organization of our event on April 12th around biodiversity. So I think that will be also very interesting, with a lot of questions. You know, how do we measure and how do we actually take into account something that is so complex and multidimensional versus the almost simple CO2 question. So with that, thank you very much, everybody. And I hope we see many of you
Yes.
on April 12th.
Yes, a warm thank you to our panelists. Thanks for sharing all these insights. I thought it was excellent. And thanks, Antoine and Eddie, for teaming up